Okay, so we've talked a little bit about demand curves and how they reflect people's willingness to pay for something. We drew one for Eric's demand for ice cream cones. We looked at his consumer surplus from that. And in general, just like we talked about aggregating from the individual up to a broader level, we can do that. So we've got price and quantity on some axes. We can draw a demand curve. Now this is an aggregate demand curve, we'll say. Let's say it's for ice cream cones. We've also got people willing to make and sell ice cream cones. And so there's our supply curve, upward sloping. And as you learned in microbe principles back in the day, we've got this equilibrium point, right? It's kind of magical spot where the quantity demanded equals the quantity supplied. We often refer to it as Q star, P star, because that's the equilibrium price at which quantity demanded is equal to quantity supplied, and the market clears and everything's happy. If we have people starting at some other spot on here, if we have a price above equilibrium price, there's going to be pressure. We're going to end up with a surplus. There's going to be people wanting to make more than people are wanting to buy. So there's going to be downward pressure on prices because people who make and sell stuff don't want to be just building up inventory and sitting on it. And likewise, if we start with a price below equilibrium, people are going to want more than people are making and selling. So there's going to be a shortage. That's going to end up with price pressure going up, right? If people selling stuff realize they can raise the price and still sell everything, they'll tend to do that, and we tend to end up at equilibrium. So a big question for our class, thinking about environmental stuff, is how efficient is this? So you may or may not recall from basic econ theory, generally speaking, the market equilibrium is efficient. We've maximized the amount of consumer surplus plus producer surplus. So I'm going to shade in this area above the price but below the demand curve. That's showing what people would be willing to pay minus what they actually pay. So that's their surplus. That's what they gain. And so we see the most surplus for these people here that would be willing to buy a lot. They don't have to pay that much. They only pay this, so they get that much surplus from it. As we make our way down the demand curve, so I'm thinking here of a market demand curve with a lot of people in it, and we've kind of ordered them in terms of how much they're willing to pay for something, until we go down and we get the people right here who are facing a price that's almost exactly what they're willing to pay for something. The person right at the end, they're actually indifferent between buying this thing or not. They're not actually going to get any consumer surplus if they buy it because, you know, the price is $4 and they get $4 of joy out of eating that ice cream cone, so they don't really care. But the person right next to them who gets $4.01 of enjoyment out of that $4 ice cream cone, they're not a lot better off, but they're better off being able to buy it. So that's our consumer surplus, right? And we've got our producer surplus. That's this area here. So producers are willing to sell stuff for this amount, but they'll actually get a price here. So they're gaining by being able to sell these things. And that's true of each of those units, again, starting with big amounts until we get to the producer who's just indifferent between making and selling that last unit or not. So that's producer surplus, consumer surplus plus producer surplus gives us total surplus, and basic econ tells us that the total surplus is as large as possible when we're in equilibrium. So that is the efficient outcome. That's the best we can do. Now, in this class, we start to pick that apart a little bit. So we have to think a little bit more about what we mean when we have this demand curve. So we said this was showing how much people are willing to pay for something. But there are often things that have spillovers, right? So I may be willing to buy a cheaper lawnmower because I hate loud lawnmower sounds. Actually, leaf blowers would be the better example. I hate loud leaf blowers. I hate the sound, I hate the smell. So there's a demand for quiet leaf blowers. Maybe those are old-fashioned rakes or electric leaf blowers, let's say. So I would be willing to pay a certain amount for an electric leaf blower because it's so much quieter than the loud two-stroke engine ones. Now, my neighbors actually care about this issue too, because if I'm using a leaf blower, my neighbors have to listen to it as well. And I might be trying to, get my yard work done when it's still relatively cool, so it's in the morning. Maybe they're still trying to sleep. So there's actually a willingness to pay that my neighbors have for me to use an electric leaf blower. So they would actually prefer if I have that, and they would be willing to pay something, reflecting that value they have from having more quiet in the mornings, especially on the weekends. Now, the demand curve is showing what I am willing to pay. I'm somewhere around here, right? But my neighbor's willingness to pay for me getting it cheaper is usually not reflected in a traditional demand curve. Likewise, you may recall the supply curve is made up, we basically figure out where that is, what it looks like, based on the marginal cost curve for firms. What's their cost of producing an additional unit? As you change the number of units, that is a changing thing, and we are adding this up for all the firms in this market, and that's what's giving us this supply curve. So it's based on marginal cost. But those are the costs for that company, the cost that they actually face. And so they're paying for labor, they're paying for their input resources, they're paying for the permits that they need to operate, they're paying to transport things, etc., etc. But very often, firms are doing things that they don't necessarily have to pay for that are still affecting other people. So a classic example, and very fitting for this class, is pollution, right? So a firm is able to release stuff into the river, and they don't have to pay anything for that. It gets rid of this stuff that is a byproduct of their production process. And so that gunk that's going in the river, let's say it's a paper mill, like the example I talked about before, they're releasing this pulpy stuff into the river. It's making the river not look so clean. It's making it not smell so clean. It's actually creating some problems, things called biological oxygen demand, a measure of how much we're kind of straining this water ecosystem by putting a bunch of nutrients in there that shouldn't be in there. So the biological oxygen demand has gone way up. The fish are not doing well. Maybe dissolved oxygen levels have gone down. We start losing things like crayfish and some of our biodiversity. The people who live along this river would care a lot about that, right? At least some of them would. Some wouldn't care that much. Some keep their windows closed and never go down there. But other people like to sit by the river at sunset. So if it doesn't smell good, that's a problem. If it doesn't look as pretty, they care about that. Maybe someone likes to go fishing in the river, and now there aren't as many fish. Or maybe there are fish, but they may not be as safe to eat because of the pollution from the paper mill, right? So those are all things that people care about. That means they would be willing to pay something to prevent having those. There's actually a cost that they're incurring when those things happen. But that's not reflected in our typical supply curve based on the private marginal cost of production for the paper mill itself. So what we think about in a class like this is, well, if we're really talking about an efficient outcome, we need to be stacking together willingness to pay measures for everyone, even people who aren't directly participating in this market. Our real demand curve may not be right here. It may be, I don't know, right there. Because there's some other willingness to pay of people who aren't direct participants. Same thing with the supply curve. I'm going to draw kind of a big shift here. There's all of these external costs, publicly incurred costs, that go on top of the marginal private cost that made up our supply curve. But that didn't account for all of the costs that are being incurred by people who live along that river who are being harmed by the pollution. If we factor in all of those, it may change things. And the way I drew it in this market, it did change things. So now, if we knew this proper level, it would actually be right here. So I'm going to call it PE, QE. So what's this saying is, if we actually knew everyone's preferences and how they were affected by different things, we had good willingness to pay measures for them, we'd be able to say the efficient price for paper, in this case, is right here, which is higher than what we see in an unregulated market. The quantity is actually scaled back from what we see in the market. To get the biggest consumer and producer surplus, we actually need to scale back and have a higher price, reflecting the changes that come from accounting for all these spillovers, these externalities that are happening in this market. Now, this is kind of a tough pill to swallow. One reason is because it's such an important part of economic theory that the market outcome is the efficient one that creates the biggest area of total surplus. And that messing with that, with government programs and government policies, is going to end up hurting people. It's less efficient if we mess around with the market than if we just let it do its thing. That's such a important part of basic economic thinking that it's a tough pill to swallow to look at this big surplus we thought we were getting, and someone comes in and tells us, well, actually, this is the best we can do. The efficient outcome is one here where we have this producer surplus and we have this consumer surplus. It's a little bit hard to see, but this triangle is smaller than that triangle. The shaded green and pink area that we thought we were getting for total surplus is bigger than what we're getting here. So it's a tough pill to swallow to think, wait, our efficient thing is to scale back production and raise prices, and we actually end up with smaller total surplus. So how is it that that can be the efficient thing? How is it that it's best for the government to step in and try to jack up prices in this paper market? There's good reasons people are pushing back from a lot of environmental regulation, because that is not a happy story. Why it's important to think about this story is because what we were looking at as surplus before was not accurate. We were wrong. We were looking at only a subset of the things that go into the true demand curve and the things that go into the true supply curve, reflecting the externalities as well. So our previous outcome right here, if we account for where we really are, we're actually in pretty rough shape. So we do have a pretty good chunk of consumer surplus, all the area below the demand curve and above the price in the market. So we've got some true consumer surplus. Our true producer surplus is actually this tiny little triangle right there. So being more accurate with the way we measure the things that go into the curves that tell us what the efficient outcome is, that may be kind of a bitter pill to swallow, because it may be telling us we have to take some hits. But if we are going to do the best we can actually do, that may mean we need to account for these externalities in a meaningful way and do stuff like make our paper a little bit more expensive. So that's going to be one of the big lessons in this class, is thinking about this idea of measuring things that accurately reflect how people really feel about these different situations. And it's not always easy. In fact, it's often quite difficult, because we're often talking about things like changes in environmental quality because of pollution that they're hard to think about. They're hard to measure. We don't see them bought and sold in markets unless you're watching the remake of the Lorax that I think it's a DreamWorks film, and there's this kind of bad guy who's selling fresh air in bottles. He's let everything get so polluted so he can sell bottles of fresh air for people. That's not the world we live in, but it means that figuring out how much people value a change in air quality is a tricky thing to do, because they're not going out and just buying it directly. So for now, think about these supply and demand curves. Think about having them reflect the externalities that we know are inherent in a lot of things involving pollution. That's why environmental economics is its own field of study. These answers are not easy to come by, but they're important. We know that people really do value changes in environmental quality, and we know there are these substantial externalities that come from pollution from a lot of different production processes. So it's an important topic. It's one that I know a lot of you guys care a lot about. And so what we're going to be doing going forward is learning more about how to actually start to measure some of these things, so we can say where the real supply curve should be, what it really looks like, not just what we see in the market, kind of. So I'm going to leave it at that for the moment. I will see you guys soon. Thanks.